Hey guys, hope you guys are enjoying your weekend. Today I'm bringing you a dividend ETF review. If you haven't noticed by the title, we are looking at an ETF from Ishares, which they call their core high dividend ETF. So we're going to dig into it, see what makes it tick, see what holdings and sector allocations are in it, and yeah, let's check it out. So if you're new here, please like, share, subscribe, all that stuff. Down below in the pinned comment is all my info. If you'd like to support this channel, all that info is down below. So today we are looking at HDV. That's the iShares Core High Dividend ETF. And they classify that as a large value equity ETF. Now, this iShares ETF has $5 billion in assets under management as of October 31st. Has a decent expense ratio of 0.08. For some reason, Fidelity's not showing my distribution yield here, but we'll get to that in a little bit. Funny thing is, this investment seeks to track the investment results of the Morningstar Dividend Yield Focus Index. Okay. And then you look over here at the Analyst Ratings, and Morningstar rates this ETF as a 3-star rating, which seems interesting to me. But this one has been beaten down a little bit, and it hasn't really participated in the recovery this year. So we'll take a look and see why, see if we can find out why. So we'll go here to the portfolio composition. Actually, first thing we'll do is we'll look at what makes up this ETF. So the Morningstar Dividend Yield Focus Index is designed to track high-yielding, qualified dividend-paying U.S.-based securities, screened for companies with superior quality and financial health. Let's see. So the Yield Focus Index represents the top 75 high-yielding stocks that meet the screening requirements. So we'll take a look real quick at the screening requirements. And the Morningstar Index methodology determines company quality in accordance with the Morningstar Economic Moat Rating System, in which companies are expected to earn above average profits and sustain their dividend. Stocks in the underlying index are designated as having a rating of either narrow or wide based on the prospect of earning above average returns on capital and the strength of the company's competitive advantage. Additionally, companies are screened for financial health using Morningstar's distance to default measure, a quantitative option pricing approach that estimates a company's probability of default. To qualify for inclusion in the underlying index, constituents must have a Morningstar Economic Moat rating of narrow or wide and have a Morningstar distance to default score in the top 50% of eligible dividend-paying companies within its sector. For those companies that are not assigned a Morningstar Economic Moat rating, the companies must demonstrate a Morningstar distance to default score in the top 30% of eligible dividend-paying companies within its sector. Additionally, each constituent's dividend must be deemed to be qualified income. So they're looking at the financial health of the company and making sure that they can provide steady dividends is essentially what they're doing. Again, you know, how they come up with some of these formulas is interesting, but let's take a look at what makes HDV tick. So they're going to generally invest at least 90% of its assets in the securities of that index. Okay. So currently they have 78 holdings. Top 10 takes 56.83%, and the other 68 holdings garner 43.17%. And it's essentially all United States exposure at 99.54%, with just under 0.5% in Switzerland. Now, if you look at the top 10, you're going to see pretty recognizable names and pretty strong dividend-paying companies like AT&T, at 9%, ExxonMobil at just under 8.5%, Johnson & Johnson at 6.5%, Verizon at 6.5%, Chevron at 5.5%, Pfizer at 5.5%, Coke at 4%, Pepsi at 3.7%, Cisco Systems, that's the tech company Cisco Systems. And if you didn't see, Dave from Hidden Freedom Investing, he did a video yesterday on Cisco and their earnings report, and check that out. I'll leave a link up here and down below. So Cisco Systems holds a 3.66% weighting, and Merck 3.66%. So very heavy in the top 10, all quality companies. And if we look at the market cap, excuse me, look at the market cap, you have 90% in large cap, 8.5% in mid cap, and 1% in small cap. And like I said before, Morningstar rates this as a large cap value fund. Now we look at sector exposure. You have 20% in healthcare, which is nice. This one's a tad concerning, but after talking with some people, I've kind of changed my tune. Energy at 18% in this one. Communications services in 15.67, consumer staples at 13.2, utilities at 11, information technology at just under 7, financials at just under 7, industrials just over 6.5, materials 0.85, and consumer discretionary at 0.69. Now I've changed my tune on energy because yes, we are gonna go eventually to more renewable energy. But I have a hard time believing that these oil majors like Chevron and Exxon aren't still going to be the big players in renewable energy. I don't think they're just going to sit back, roll over, and die. I think they're going to capture that market, and Chevron and ExxonMobil are still, even when we shift to renewable energy, going to be the major players in it. So could take decades, but I think there's some big truth to that the big energy companies are still going to be big energy companies regardless of where that energy is produced or comes from. That's an opinion, but I think it's a pretty good one. Now, what I believe the weakness is in this portfolio is a couple of things. Consumer discretionary at 0.69. That is that's going to be a big pull down or a big drawdown or a weight on this portfolio, because consumer discretionary is a very strong sector. Okay, and that's probably why this hasn't recovered very well, with that consumer discretionary allocation being so little. That, along with information technology being only 7%. That's going to weight this portfolio down. But the reason why information technology and consumer discretionary are not weighted so much is because there's not very much dividends in those sectors. So when you're getting into a dividend fund, you're probably going to be lightweight tech, lightweight consumer discretionary, because those are high growth sectors. So let's take a look at some of the dividend history of HDV. Like I said, they're still down 10% for the year. They've had a big run up here in the past, past 3 weeks or so. They went from 77.25 up to the current 85.57. We'll look at the dividends. Now, the strong point on this is that the dividend history on HDV is really strong, really steady, and growing. It doesn't grow as fast as some other ones, but it is consistent. We look at the dividend growth rate, 5-year dividend growth rate of 5.5%. Had a little dip there in 2014 to 2015, but the consistency of the dividend is pretty nice. We'll look at finally at how HDV has done against, we'll do it against another high yielding just for fun. VYM, I done a video on that. If you'd like to see it, I'll link it up top and down below. And it's just another high dividend ETF, and we'll just see how it's done over its lifetime. So if we look at HDV, it has underperformed the VYM just slightly. HDV had a total return of 134.68% for an average annual return of 9.24% versus VYM's 167% and the average annual total return of 10.72%. And these are both from March 31st of 2011. So, would I recommend this fund? Yes. I think if energy can make a comeback, this definitely can also. Like they're heavy in Chevron and Exxon, where I think those represent the best opportunities in the energy space. They're the biggest names in the world in that space, so it's really prudent to be in those positions if you're going to be in energy right now. The consistency of the dividend is nice. The growth could be better. It only had 5% annual growth rate. It's good. It's okay, but it could be better, and maybe in time it will. Looks like it's recovering. Along with maybe next year it'll go into value. Maybe value investing is its turn right now. So we'll see. Overall, I like the fund. I think it needs to have, if you're going to have this fund as a core holding, you're going to need to either pick up a consumer discretionary sector ETF or some single stock picks on your own. Yeah, that's it, guys. Give me your thoughts down below. Like, share, subscribe, do all that good stuff. If you could, please use my Amazon link that's down below at no extra cost to you. If you use that link, Amazon sends me a small commission on qualified purchases. It's a great way to support the channel. So you guys have a great day. I'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.